When we talk about international sanctions, most people immediately think of frozen accounts, blocked transfers, and trade restrictions. But what happens when a state has had decades to learn how to bypass those exact mechanisms? What emerges then is a parallel financial system, complex, interconnected, and global in scale. And it is precisely this system that the US Department of the Treasury targeted on May 19, 2026. It marks a critical moment in an already escalating confrontation between Washington and Tehran, and it deserves careful analysis. Through its Office of Foreign Assets Control, known as OFAC, the US Treasury imposed sweeping new sanctions on Iran's financial and oil-related networks. Publicly available data indicates that more than 50 companies, individuals, and vessels were added to the sanctions list for allegedly helping Tehran evade restrictions and generate billions in revenue. That may sound like a routine measure, but a closer examination of the network structure quickly reveals that something systematic has been uncovered. These are not isolated actors, but a sophisticated parallel system built over many years. At the center of this operation is an institution that initially appears unremarkable, Armin Exchange, an Iranian currency exchange network that OFAC identified as a major financial hub for sanctioned Iranian banks, petrochemical exporters, and the National Iranian Oil Company. According to verified reports, this entity operated shell companies in the United Arab Emirates, Turkey, and Hong Kong to facilitate cross-border financial flows connected to Iranian oil and petrochemical trade. It was a financial channel functioning entirely outside conventional banking structures. That is the core of the issue, and this is where the analysis becomes particularly interesting. When sanctioned Iranian banks lose access to international payment systems, gaps emerge, and into those gaps step actors like Armin Exchange. They effectively perform the same functions as regular banks, only through less regulated channels combined with opaque shipping arrangements, offshore corporate structures, and alternative currency exchange systems designed to keep oil revenues flowing. Instead of transfers moving through SWIFT, payments travel through a web of trading firms in Dubai, corporate registries in Hong Kong, and shipping registrations under third-country flags. As the individuals responsible for Armin Exchange, the US Treasury specifically named Youssef Ebrahimi, a Turkish-Iranian Dominican national, along with his brother Mahmoud, the Iranian citizen Sam Nemati, and the Turkey-based Iranian national Ali Hasrati Kerlo. The publication of these names carries political significance. The issue is no longer limited to abstract corporate structures, but now involves real individuals who may be based in Istanbul, Dubai, or Hong Kong, and are now listed by the world's largest economic power. Official information also reveals a structural pattern. Senior operators in such shadow banking networks routinely hold multiple foreign citizenships, often obtained through offshore jurisdictions via so-called citizenship by investment programs. These documents, which can cost hundreds of thousands of dollars, allow such individuals to travel freely and establish new companies abroad. In doing so, Washington is signaling that it understands the mechanisms, recognizes the vulnerabilities, and is beginning to close them systematically. Why is all of this relevant now? Because it is not happening in a vacuum. Since the spring of 2026, the United States and Israel have been engaged in a serious security confrontation with Iran, which at one point led to the temporary closure of the Strait of Hormuz, one of the world's most important maritime routes for energy shipments. A temporary ceasefire took effect in early April, but subsequent rounds of negotiations have so far failed to produce a lasting agreement. In this context, financial sanctions are not an isolated instrument. They are part of a broader pressure system deployed alongside diplomacy and military presence. This is the framework in which the events of May 19th must be understood. A careful reading of the sanctions list issued on May 19, 2026, reveals a geographical pattern that is far from accidental. The sanctioned shell companies are spread across three major hubs: Turkey, the United Arab Emirates, and China, including Hong Kong. Each of these regions serves a specific function within the network, and the interaction between all three makes the system especially difficult to dismantle. Among the specifically designated shell companies on the Chinese side are Ningbo Jiarui Trading Company Limited, as well as Hong Kong-based firms such as Starshine Petrochemical Corporation Limited, Vigorous Trading Limited, Best Fortuna Company Limited, and Chengpan Company Limited. In the United Arab Emirates, Alien Goods Wholesalers LLC, Bold Trading FZE, and Materium Group FZE were added to the sanctions list. These names sound like entirely ordinary trading companies, and that is intentional. The more inconspicuous a company appears, the harder it becomes to isolate it from the international financial system. Hong Kong plays a particularly important role in this structure. As a former British colony and part of the People's Republic of China, Hong Kong maintains its own legal system, independent corporate registries, and a historically developed infrastructure for international financial transactions. At the same time, transparency remains limited, and access to company ownership data is difficult for Western authorities. This makes Hong Kong a preferred location for complex corporate structures spanning multiple jurisdictions. This is not an accusation against Hong Kong as a financial center. It is a structural reality that actors seeking to bypass restrictions strategically exploit. Turkey represents another critical point. As a NATO member and an important trading partner of both the United States and Iran, Ankara occupies a structurally complex position. According to verified reports, the network used shell companies in Turkey, the United Arab Emirates, and Hong Kong to manage cross-border financial flows and sanctioned Iranian trade. For Ankara, this means that companies operating under Turkish jurisdiction are now on the US sanctions list, carrying immediate consequences for their banking relationships, trade financing, and access to insurance services. The public identification of Turkey-based structures places pressure on the Turkish government to take a position, even though Washington typically prepares such measures through diplomatic channels. Equally significant is the maritime dimension of this sanctions operation. Alongside the financial networks, 19 vessels were simultaneously designated for allegedly transporting Iranian oil, liquefied gas, methanol, and petrochemical products. Among those specifically affected are a Barbados-flagged liquefied gas tanker named Great Sail, a Palau-registered product tanker called Ocean Wave, and a Panama-flagged chemical and oil tanker known as Swift Falcon. The use of multiple flag states demonstrates how these ships are shielded from direct law enforcement oversight through so-called flags of convenience registrations. According to official information, Armin Exchange cooperated with sanctioned Iranian banks and petrochemical exporters, including the National Iranian Oil Company, the Persian Gulf Petrochemical Industry Commercial Company, and Trillions Petrochemical Company Limited. These are not minor entities, they are central pillars of the Iranian economy. The connection between these state-linked corporations and a seemingly private exchange house illustrates how fluid the boundaries between the public and private sectors in Iran become when sanctions evasion is involved. In addition, the US government explicitly warned foreign companies and financial institutions that continued participation in Iranian oil trade could expose them to the risk of so-called secondary sanctions. Multiple sources confirmed that the warning specifically referenced Chinese independent refineries, commonly known in industry terminology as teapot refineries or TPOT refineries. These small, privately operated processing facilities in China's Shandong province are responsible for the majority of Chinese imports of sanctioned Iranian crude oil. The explicit mention of these actors in the sanctions announcement represents a direct message to Beijing, not in the form of a diplomatic note, but as a public warning. Observing how Washington has intensified its sanctions pressure over recent months reveals a clear strategic pattern. The focus is no longer on symbolic measures, but on the deliberate dismantling of the infrastructure Iran has spent years building to secure revenue streams. The campaign pursued by the Trump administration under the name Economic Fury follows a consistent logic. Whoever controls the flow of money exerts structural pressure, regardless of how diplomatic negotiations evolve. This is a decisive point because negotiations are taking place simultaneously. Multiple sources confirm that talks are being held between Washington and Tehran through intermediaries, including Oman, aimed at reaching a more durable agreement, particularly regarding issues connected to Iran's nuclear program. The simultaneous imposition of sanctions while negotiations continue raises an important question. In this context, are sanctions a tool designed to expand leverage at the negotiating table, or do they undermine the trust necessary for serious diplomacy? The answer is likely both, depending on the perspective. From Washington's viewpoint, financial sanctions are considered a legitimate instrument of pressure that can operate alongside diplomacy without fundamentally endangering it. The message is clear. We are negotiating, but we will continue weakening your economic foundation until an agreement is reached. From Tehran's perspective, however, this very combination could be interpreted as a sign that Washington is not seeking a genuine negotiating partner, but rather trying to buy time in order to maximize pressure. This is not a theoretical scenario. It is a real line of tension that will shape the course of the negotiations. Another important dimension is the reaction of the sanctioned third-party states. Neither Turkey nor China is likely to accept the designation of their companies on U.S. sanctions lists without response. Beijing has consistently emphasized in the past that it does not recognize unilateral sanctions and opposes their impact on Chinese companies. Publicly available information suggests that since the intensified U.S. pressure campaign began, China has increasingly concealed its purchases of Iranian crude oil. Smaller brokers, alternative payment channels using Chinese yuan transactions, and more frequent ship-to-ship transfers at sea have become more common. This means sanctions slow the system down, but they do not completely shut it off. At this point, a counter-perspective is important. There are respected analysts who fundamentally question the effectiveness of this type of financial sanction. Their argument is straightforward. As long as a buyer like China remains willing to purchase Iranian oil, even at a significant discount to global market prices, Iran will continue finding ways to deliver it. Ships change names, companies are dissolved and re-established, and networks relocate. The United States can close individual nodes within the system, but the structure itself remains intact as long as the economic incentives on both sides remain strong enough. This is not a pro-Iranian argument. It is a sober assessment of the limitations of sanctions policy, one that is also reflected in academic literature on the subject. At the same time, the recent measures appear to have produced tangible effects. According to verified reports, several of the previously sanctioned Chinese TPOT refineries have in fact reduced or temporarily suspended their imports of Iranian crude oil. Not because of political conviction, but because the sanctions risks for their financing partners and insurance providers became too high. This demonstrates that the mechanism can work when applied with sufficient precision. The key question is whether the impact is strong enough to genuinely alter Tehran's negotiating position, or whether it simply forces the network to become more adaptive and sophisticated. Another aspect that is often underestimated in public debate is the signaling effect of these measures on neutral third-party states. Banks and financial service providers in Turkey, Hong Kong, the United Arab Emirates, and elsewhere are now facing a clear choice. Either they carefully examine their client relationships for potential Iranian connections, or they risk becoming targets of U.S. sanctions authorities themselves. The Treasury Department has made it unmistakably clear that financial institutions cooperating with sanctioned networks could be excluded from the U.S. financial system. For any bank with international ambitions, that represents an existential threat, regardless of where it is headquartered. This indirect pressure on intermediaries may be the most effective element of the entire campaign. To understand where this development is heading, one must step back and examine the broader picture. What we have observed since the beginning of 2026 is not a spontaneous response to current events. It is the implementation of a strategic doctrine formally codified in February 2026 through National Security Presidential Memorandum No. 2, which defined maximum economic pressure on Iran as a central instrument of foreign policy. The sanctions imposed on May 19th are not an exception. They are the most visible expression so far of a continuing and systematic strategy. At the same time, we are at a moment where several geopolitical fault lines are converging. There are ongoing nuclear negotiations, a fragile ceasefire, a still restricted situation around the Strait of Hormuz, with direct consequences for global energy markets, and now a sanctions operation simultaneously targeting Tehran, Ankara, Abu Dhabi, and Beijing. That is an unusually broad target range for a single measure, and it is not accidental. Three scenarios appear realistically possible. In the first scenario, Iran gradually adapts its network. Shell companies are re-established, ships are re-registered, and payment channels become even more decentralized. The measures create substantial friction, but not a complete freeze of revenue flows. This scenario aligns with the behavior observed over recent years, and is therefore the most likely. In the second scenario, the cumulative financial pressure accelerates the ongoing nuclear negotiations. Tehran sees diminishing economic room for maneuver, while Washington offers targeted sanctions relief in return. An agreement would be possible, but it would require a level of mutual trust that is currently difficult to assess. In the third scenario, the Sino-American confrontation deepens in the field of financial policy if Beijing decides to openly counter the pressure on Chinese companies and implement its own retaliatory measures. That would place the Iran issue within a broader geopolitical conflict extending far beyond Tehran itself. One aspect deserves particular attention: the reaction of Turkey and the United Arab Emirates. Both countries have strong economic interests that do not always align with Washington's priorities. How they respond to the public naming of their companies, whether through active cooperation, silent observation, or diplomatic objection, will reveal how far US pressure actually extends. Which scenario ultimately emerges depends on a question that remains unresolved for now. Is the economic pressure strong enough to genuinely shift Tehran's strategic calculations? Or does it merely force the system to become more resilient and harder to penetrate? Historically, sanctions alone have rarely compelled fundamental political decisions. The decisive factor will be whether Washington combines its pressure campaign with a credible diplomatic offer. That remains the unresolved puzzle of Western policy toward Iran, and as of May 2026, it remains unanswered.